Our discussion here is going to assume that you've already gone through and understand a forward contract for the most part, but as a quick review, remember that forwards and futures are simply contracts for delayed delivery. That is, we are assuming what the contract that we're entering here. If we are the long, we are agreeing to buy a commodity in the future. Okay? So we're going to buy something in the future at a price we determine today. Okay? The short is going to sell. So remember, the long wins when the price increases. I'm buying something. If I buy something, the price goes up, I win. Okay? And of course, the short, the one who is selling, wins when prices fall. So, and of course, if that logic is not clear to you, let me urge you to go back and look at the previous topic summary in this video series on forward markets. So forwards and futures are essentially the same thing. Okay? What we're going to see as we go through these first couple of slides, there I can spit it out, is that essentially a futures contract is an exchange traded forward contract. Okay, so when we're talking about a futures trade, okay, then we have a contract, of course, that's going to specify the quality and the quantity of the underlying good, the delivery time and the delivery manner, where it's going to be delivered, if it's a physical commodity, those types of things. Okay, then we also, as opposed to when we're dealing with a forward contract, we now have an exchange involved. So the exchange operates as the clearinghouse, and they are the buyer to every seller and the seller to every buyer. So the clearinghouse holds the other side of every contract, and the clearinghouse is going to specify the minimum price tick, that is, how much, what's the minimum that the price can change by. So we're going to work with a wheat example in just a moment, and the least amount that a bushel of wheat can change by is 1 penny. Okay, they are also going to establish daily price limits, which is going to be an up limit and a down limit. Trades won't take place outside of those limits, and we'll have a little more to say about that in a little while. Okay, now one thing that is different about futures as opposed to forwards is this idea of margin. And I want you to be careful with this word, because we've used margin. If you've gone through the rest of the curriculum and getting here to this derivatives material, then we've used the word margin a couple of times, and when we've used it previously, okay, it has referred to, at least in terms of investing, it is referred to an equity contribution. So we said, look, we're going to buy some stock on margin. If the margin requirements were 40%, that means that we're going to buy $100 worth of stock. We're going to put up $40, and our broker is going to get us a loan for the rest of that $100 stock purchase that we're making. So the margin was the required equity contribution if we were talking about buying stocks and bonds. Basically, it's buying stocks and bonds with borrowed money. However, here, margin does not mean that. Okay, what margin means, a better term would be a security deposit. So remember, forward and futures contracts are free. You just enter into them. You don't have to pay anything, okay, but you do stand to lose money over time as prices change. You have to put up a margin deposit or a security deposit to fund any potential losses, so that everyone involved knows that you can in fact fund any losses that you receive. So margin is going to be posted on these accounts, and they are going to be marked to market daily, okay, which is going to be a big deal. We'll talk about that again in just a little while, but basically that means we're going to realize cash flows, cash inflows if we win during a particular day, and cash outflows if we lose. So we're going to settle up at the end of every day. So the margin is a performance guarantee, again, not a loan. Okay, remember, the long is agreeing to buy. If you're buying, you hope the price is going to go up. Okay, a short is going to sell. If you're locking in a price to sell, of course, you're betting that the price is going to fall. Okay, so what about direct contrast between forwards and futures? Okay, well, forwards, recall, were private agreements, okay, whereas a futures contract is an exchange traded agreement. So everyone can see exactly what it is that's being traded. So all the futures contracts, all the wheat futures contracts that are traded have the same characteristics. Okay, so since we negotiate the custom agreement for a forward contract, it can have very specific attributes. However, if we're talking about an exchange traded contract, well, all the contracts have to be standardized. Okay, we mentioned the idea of default risk or counterparty risk when we were talking about forward agreements. Okay, well, if you have an agreement between two private entities, there's always the possibility that one of them is going to default. However, when we talk about futures futures markets, okay, then we have the clearinghouse standing between the contracts. The clearinghouse is, of course, the buyer to every seller, the seller to every buyer. So they are, one, well capitalized. Two, they are the ones that control the margin accounts. And three, they also control daily price limits. So we're going to work on the notion that there is no counterparty risk in futures. Now, I can envision in my mind a scenario where that isn't exactly true, but nonetheless, that's going to be the party line for the exam. Okay, when you deal with a forward contract, you don't have to worry about margin, okay, but you do have to put up a security deposit if you are dealing in the futures markets. And of course, there's a difference in regulation. Very little regulation of the forward contracts. These are just private financial contracts, whereas futures trades are, of course, highly regulated. So this is the idea of forwards versus futures, and I think this is one of the main things that you can get on top of for this reading. One of the idea or the ability to distinguish between a forward and a futures contract, because the underlying fundamentals, okay, are exactly the same. Both of these are simply contracts for delayed delivery. Now, let's talk about some margin terms. And so as we talked about with stocks, when we talked about buying stocks on margin, we used the term initial margin. Well, we're going to have an initial margin here also, okay, but that's just going to be the size of the security deposit that we put up. Okay, we're going to have a maintenance margin. That's going to be the minimum that we have to keep in our margin account. Okay, variation margin, this is the funds needed to restore the futures account to its initial margin level. Okay, now this is something we've seen that's different here. So when we talked about stocks or bonds and buying those with a loan, okay, buying them on margin, if we were to receive a margin call, so we started out with 50% margin, we had a 30% maintenance margin. If we fell below 30%, then we had to bring the account back up to 30%. If we fell below 30% again, we had to come back up to 30%. So we had to maintain the maintenance margin. That is not what happens if you get a margin call in the futures markets. Okay, if you get a margin call, that is your margin account has fallen below the maintenance level, then you have to go all the way back up to the initial level. So you've got to take it not back up to the maintenance requirement, but all the way to the initial level. Okay, and the settlement price, that's just the average of trades that occur. At the end of the day, it's not the final trade of the day, but it's something, it's okay to think of it that way. All right? Okay, so what about a futures trade then? So let's look at a July wheat futures contract. It calls for delivery of 5,000 bushels of wheat in July at a futures price of $2 per bushel. The contract value then is 5,000 bushels times $2 per bushel. So in this case, if you are long a wheat contract, a July wheat contract, you are agreeing to buy a $10,000 worth of wheat, 5,000 bushels at $2 a bushel. Okay, if you are short, you're agreeing to deliver this same 10,000 bushels of wheat. So the long's obligated to buy, the short's obligated to sell. Both parties have locked in the transaction price. There's no optionality here. The long is agreeing to buy, the short is agreeing to sell. Okay, both the long and the short are going to post the same margin account, same margin amounts. So the exchange will say, if you're going to trade a wheat futures contract, you have to put up X number of dollars. We'll get into that in an example in just a moment. What happens in July when we observe the price of wheat? Well, if the price of wheat goes up above $2, then the long is going to gain, right? So I've locked in a price to buy at 2. If the price has gone up to 2.10, then I buy at 2. I can sell at $2.10. I make 10 cents on each bushel times 5,000 bushels. That would give me my profit. If it ends up less than 2, then the short is going to win. And of course, if it were to end up exactly at 2, then there would be no gain or loss to either party. So looking at the futures trade, that's the idea behind what happens. Let's talk about price limits for just a moment. So price limits here, we're talking about exchange imposed limits on how much the contract price can change from the previous day's settlement. So this is sometimes referred to as a circuit breaker. So if we look at a barrel of oil and we see what the closing price was yesterday, well, if the price really starts to rocket, we can hit the limit up. Okay, if the price really starts to fall, we could hit the limit down. Okay, well, the point here is that the variation or the change in the value of the position in any given day is going to have a limit imposed on that by the exchange. So exchange members, okay, are prohibited from executing trades outside of these price limits. So if the new equilibrium price is above the upper limit or below the lower limit, then trading is simply going to be halted that day. Okay, we'll start with that as the limit price as our closing price for one day, and the next day we'll start from there. So the idea is if the price changes too dramatically, What we don't want to see is we don't want to get people to get too excited. So the idea is, okay, so the price of the barrel of oil is changing pretty dramatically, but let's go home. Let's go home and think about it before we do anything else. So price up, limit down. I'm not personally a big fan of these circuit breakers, but nonetheless, that is the case in the markets, and that is certainly the statement that applies to them for the curriculum. What about marking to market? Well, we've talked about this a little bit already, but the notion here is pretty straightforward. So the marking to market process is simply the process of adjusting the margin balance in the futures accounts each day. So what happens if I'm long a bushel of wheat and the price goes up? Okay, then I have made a gain during that day, right? Well, that gain is going to be added to my account that evening, right? And of course, if the price of wheat were to go down, then I've lost money that day on my position. Okay, well, the money that I've lost will actually be taken out of my account and then put in the deposit and put in the account of the corresponding contract. So this is just the idea that you can really think of a futures contract as a series of one-day forward contracts because we settle up at the end of each day. So the exchange can require marking to market more frequently than daily if there's lots of price volatility. So they could say, well, let's settle up at lunch and then settle up at the end of the day also, although that would be a fairly a rare occurrence. So you can think of this as at the end of the day, if you've won, you're going to receive your cash flows. At the end of the day, if you've lost, you're actually going to have to cough up the money out of your margin account to cover your losses from the day. So the accounts are marked to market every day is the point. Let's look at an example of a margin calculation and what happens with this marking to market process. So what happens if we are long 5 July wheat contracts? Okay, so each contract is 5,000 bushels. The futures price is $2 a bushel. The initial margin is $150 per contract. The maintenance margin is $100 per contract. Okay, so for every contract we're trading, we're going to have to put up $150. So we've got to put up $750 in order to control these 5 contracts. If at any time our margin account falls below $500, then we are going to have to bring in enough money to bring our margin account back up to the original $750. Okay, so that's the idea here. We're going to trade 5 July wheat contracts. We're going to put up $750 in our margin account. We can't let our margin account fall below 500. If that happens, we're going to get a margin call, in which case we'd have to bring it all the way back up to $750. So what happens here? Well, remember that if we have 5,000 bushels, okay, and the price of wheat changes by 1 penny, what does that imply happens to the value of a contract? Well, there's no magic here. When we talk about a penny being a $50 change in the value of the contract, well, let's see, I've agreed to buy 5,000 bushels. The price goes up to from 2 to 201, so I've made 1 penny per bushel. Well, that's 5,000 pennies. Well, that's $50. So every 1 penny change in the price of wheat is going to cause a $50 change in the value of the contract. So if wheat goes up by 1 penny, okay, for every contract I've traded or every contract I'm long, I'm going to make $50. For every contract that I'm short, I'm going to lose $50. So now we're talking about owning 5 contracts, so all we're going to do is multiply that by 5. So if there's a 1 penny change in the price of wheat, okay, then that's going to increase so in this case if it goes up by a penny, okay, then that's going to increase the long's margin account by $250, and of course in a corresponding fashion, okay, if we're talking about the short side, if the price of wheat goes up by 1 penny, okay, and someone was short 5 contracts, then they are going to lose $250 on that particular trading day. So to put a scenario to this, we can look at a little example here. So this is for our 5 wheat contracts. We're going to start out with a margin of $750. We are long, okay, at $2 a bushel. So at the beginning of the first day, we deposit $750. We enter into these contracts to buy 5,000 bushels of wheat per contract over 5 contracts at $2 a bushel. Okay, so we are agreeing to buy $50,000 worth of wheat here, and our beginning balance is $750. Well, if you do this like I do it, then during the first day, the price, you're long, so the price is going to fall. So the price falls by 2 pennies. What does that mean? Well, what that means in this case is that I've lost $250 per penny change, right? One contract is a $50 price. I'm long, the price is going down, so I'm losing. If it had gone down by 1 penny on one contract, I would have lost $50. Okay, I've got 5 contracts, so a 1 penny change makes a $250 loss. but this time price went from 2 to $1.98, so it went down 2 pennies, so I lost $500. What happens? I finished the day with $250 in my margin account. Now what's the problem with that? Well, the problem with that is that the maintenance margin was $500, right? So that's what we said. You had to keep at least $500 in your account. I have fallen below the maintenance level, so I'm going to get a margin call. But remember, once I get a margin call, I don't have to bring it back up to 500. I have to bring it all the way back up to 750. So in this case, I'm going to get a margin call. They're going to tell me that by a certain time during this next morning, I have to bring in $500 more. So I bring in $500. So that's going to be an add to my margin account that morning. What happens to the price of wheat that day? Well, the price of wheat, I'm still losing overall, but for that particular day, okay, the price of wheat goes up. It goes from $1.98 up to $1.99, so it goes up a penny. I'm long, so I make $250. So I started the day with $250 in my account. I deposited $500 in the morning, and then over the course of the day, my gains were equal to another $250, so I end up with $1,000 in my account. And then, of course, the next day I lose that penny again and it goes back down to $750. But if you can follow the example here through step 2, I think you have a pretty good understanding of what's going on here with these contracts. All right, so that is the idea of margin in a futures contract, or in this case, in 5 futures contracts. That's something that you want to have a good handle on. Let's talk about termination of these contracts. So how do we terminate a position prior to expiration? So methods to terminate a futures position, not prior to, at expiration. Okay, so looking at expiration. So we bought this 90-day wheat contract, okay, and now it's down to the last day it's going to expire. Well, what we could do is we could just say, okay, look, I've agreed to buy wheat, so deliver it to that warehouse that we agreed on in Kansas City. Okay, so that would be delivery of the assets. Okay, remember though that this accounts for less than 1% of trades. My suspicion is that it's much less than 1%. Okay, the futures market isn't particularly designed to take delivery, okay, of the underlying commodity here. Okay, so even if I were trading wheat, so I'm long wheat, I'm buying wheat, I'm also a cereal company, so I want to I'm hedging my cost of goods sold, right? I need to buy the wheat, I'm locking in a price at which to buy it. Even if I actually needed the physical commodity, sorry, there's a fly there, even if I actually needed the physical commodity, I still wouldn't take delivery of the asset. Why? Because the delivery of the futures contract calls for delivery to a specific warehouse in a specific city. I, on the other hand, work in another city. I have another supplier I'm used to working with. So what I'm going to do is I am going to simply reverse my contract, take my gains or losses, okay, and then go buy my wheat from my normal supplier. So by far, the most common type of termination is a reversal, especially if we're talking about physical commodities. So what we're going to do is if we're long wheat coming into the last day, then we're going to short wheat. So the exchange will see that we are long and short exactly the same contract. Okay, that simply takes us out of the position. All right, so the reversal is the common way. We could also do a cash settlement. That is, if this is on a futures contract on an equity index, well then if we don't offset, if we don't reverse, okay, then we also can't deliver by definition, so we would have to do a cash settle there. This is actually fairly similar. It's letting the contract go all the way to expiration. We could also do something called an exchange of physicals, which just means that I'm long a contract, you're short a contract, we happen to meet after hours, so we realize that we have offsetting contracts, we agree to exchange, and then we notify the exchange that we've done that. Okay, that's an exchange of physicals. Okay, that's an ex-pit transaction, essentially, meaning that it's off the exchange floor, and but that is something that is allowed. All right. Okay. So that is what happens at expiration. Okay. If we talk about closing a trade by offset. Okay, so most trades, as we said previous, are closed prior to expiration or the delivery date by an offsetting transaction. That is essentially what we call a reversal. We just did it in the last 10 minutes, so the transaction was about to close, but we could also do it a week or 3 weeks or 10 weeks before the end of the contract. So if we ever want to get out of the contract, just like we talked about with forward agreements, okay, then we can take an offsetting contract. If I'm long wheat, I'll go short the same contract. So a long position in July wheat can be closed out by taking an equal short position in July wheat. So I've agreed to buy at one price. I've agreed to sell at one price. So I've locked in both the buy and sell prices. I could have locked in gains. I could have locked in losses. Okay, but the point is I am no longer subject to the volatility of the price of wheat. So once I enter this offsetting contract, okay, I am essentially out of the wheat pricing game, or the transfer of price risk in the wheat markets. So the futures price when the trade is closed determines either the gains or the losses to the particular trader. Okay, so let's talk about a couple of special cases here. Okay, so what about futures contract delivery options? Okay, this is going to pertain most closely to this idea of a T-bond futures contract. Well, remember here the short has several options. So the long is the buyer, the short is the seller, and the short has several options. Okay, one, they can choose what it is that's going to be delivered. So we're trading a T-bond futures contract, and this is a fairly deeply traded futures contract. So we're trading a T-bond futures contract. If we're the long, we're agreeing to buy a T-bond, but which T-bond? Well, for any given T-bond, there's not enough depth in a single T-bond to trade all these contracts. So what is deliverable is any treasury bond with greater than 15 years to maturity. So which bond are you buying? Well, as it turns out, the short is going to get to determine which bond they're going to deliver. Now, when we start trading in a particular when we start trading in a T-bond futures contract, the exchange determines something called a conversion ratio or a conversion factor, which says here's all the possible T-bonds that would be deliverable against this contract, and there's a lot of them, but they're also all known, okay? And we have a conversion value to compensate for the fact that they have different coupon rates and those types of things. But nonetheless, it is still the right of the short to decide which one to deliver. Okay, what's actually going to happen is what's going to emerge is called the CTD. Okay, so of all the bonds that can be delivered, one of them is going to be the cheapest, that's the C, to deliver, okay, and that's the bond that's actually going to be delivered. Also, okay, the short gets to determine when to deliver, so it's going to be any date during the expiration month. So if we buy a July T-bond, if we are long a July T-bond contract, then we're going to be delivered a CTD sometime during July. Okay, so if we're talking about commodities, the where to deliver and location is going to be sometimes specified by, is going to be something that we're going to have to determine. Okay, and the delivery options are valuable to the short because they're the ones that get to choose. They're the ones that make the decision. So, of course, they have options about which bond to deliver or when to deliver it. They're going to deliver it when it's in their best interest. So what this is going to do, all else equal, and we won't see this at level 1, but we have pricing models. Okay, these options that accrue to the short are going to decrease the futures price just a little because this is going to make the contract a little less valuable to the long since the short is the one that has all the options. All right. What about a euro-dollar futures contract? So I think my personal opinion is there's a lot less in the way of euro-dollars in the curriculum now than there used to be, but nonetheless it's still something you need to know about. So this is what we're essentially buying and selling here is a 90-day contract, a 90-day LIBOR-based deposit. Okay, so we've already talked about the fact that LIBOR has an add-on yield rather than a discount yield, which does cause some problems in our pricing models that we'll have to deal with at level 2. By convention, the price quotes are calculated as 100 minus the annualized discount. Okay, so if we talked about it being quoted at 99, that would be 100 minus 1 is 99. That means there's a 1% annualized percent, but this is a 90-day contract. Okay, so it's only a quarter of a year, so there'd be a 0.25 or 25 basis point interest rate that applied there. Okay, the contracts settle in cash. There is no delivery here. Okay, and the minimum tick, the minimum price change is 1 tick or 1 basis point, which is the equivalent of $25 on a $1 million contract. And again, there's no particular magic associated with this. So 1 basis point is 0.0001 times $1 million. Okay, well that's just $100, but remember this is a 90-day contract, so we'd have to multiply that by 90 over 360. So that's where we get this $25. So every basis point change in interest rates, when we buy a euro-dollar futures contract, we say we're going to buy it at 5%. Okay, well if interest rates change by 1 basis point, okay, then we're going to make or lose $25 based on that. So every 1 basis point change translates into 25 basis points in the contract. All right, so what about a little more on Treasury bonds here? Some of this we've already stated, okay, but this is something that I think you ought to have a handle on. So looking at Treasury bond futures, remember we said that for what's traded, the underlying for the Treasury bond contract can be any Treasury bond with greater than 15 years to maturity. And this is what gives the short the options we were talking about. It is a deliverable contract, so they can deliver any Treasury bond with greater than 15 years and a face value of $100,000. Okay, these are quoted in percents and fractions of 1% stated in parts of 32. I used to say they're stated in 30 seconds, but then my undergraduates always thought that meant twice a minute. So parts of 32. So if we look at a price of 99-16, well, what that means is, of course, that we have it's 99 and 16 30-seconds percent. Okay, so there's a percent sign, which of course is 99.5% of par. So the price quote here would be 99.5%. So anyway, that's a T-bond futures contract. And so a few details there. You will be expected, by the way, to know the details of the Treasury bond and the Treasury the Treasury securities, the bills, notes, and bonds, and perhaps the tips, okay, that we talked about in the fixed income material. You'll also be expected to know the details of some of these major futures contracts, such as the delivery options here on the T-bond futures contract. Okay, speaking of institutional detail, what about a stock index future? Okay, well, a stock index future, what we're trading here is the S&P 500. What you have to remember is that this has a multiplier of 250. That's a number I think you need to memorize for the exam. So what that says is each index point, each change of 1 point in the index value is going to lead to a $250 gain or loss on the contract. So if you are long, okay, that is you're agreeing to buy the index, okay, and it goes up by the index goes up by 1 point above the futures price at settlement, then you make $250. So for every 1 point change in the index, there is going to be a $250 gain or loss on the S&P 500 index futures contract. There's also the baby contract with a multiplier of 50, although I'm assuming that they're going to work, well, I'm not assuming, I think they're more likely to work with the multiplier of 250 on the exam, so you want to make sure that you are on top of that. And finally here, to finish out our future stuff, okay, what about currency futures? Hey, well, just like we talked about with currency forwards, this is what we're entering into is an agreement to buy or to sell foreign currencies or currencies in the future. So in the U.S., the currency contracts trade on the euro, of course, okay, the peso and the yen, among others, and the contracts are set in units of foreign currency, and the price is stated in U.S. dollars per unit of foreign currency. So if we saw a price on the euro contract of, let's say, 1.33, what that would say is we are agreeing to buy euros for $1.33. So whatever the underlying volume is, I think it's 1 million euros. So we're saying, look, we're going to buy 1 million euros at $1.33. What we're, of course, hoping is that the value of the euro is going to go up to, say, $1.34. So that means that the value of the euro has gone up, the value of the dollar has gone down. We've locked in a price to buy euros at $1.33, so we can buy them for $1.33, sell them for $1.34, and we make 1 penny on each of the euros in the underlying contract. Would be an example of how this contract would work. Okay, so forwards and futures, I think these are well represented on the exam. Make sure that you have a good handle on them. Make sure that you get on top of the institutional detail associated with the futures pricing, or not the futures pricing, but the futures prices. And I think that you can pick up some points on this topic area on the exam. Good luck.